Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.
Hey everyone, welcome back to Kitco News. I'm Jeremy Szafron here all week long in beautiful Boca Raton, Florida at the Rule Symposium 2025, where there are a lot of investors excited and watching Wall Street right now, which again is almost breaking records. Gold is holding around $3,300 an ounce, and copper, it just spiked 17% after President Trump slapped a 50% tariff on imports, or at least that's what he said in the White House. And behind it all, central banks are still buying gold, credit is tightening, and the real economy looks increasingly fragile. Our guest today predicted much of this years ago. Dr. Nomi Prins warned about central bank distortions, elite consolidation, and a global pivot into hard assets when few were paying attention. Now, her book, Permanent Distortion, argued that financial markets no longer reflect economic reality. And 2 years later, her case can only grow stronger. Great to see you, Nomi.
So good to see you again. Thank you.
You heard it here. We got lots to get into right off the top. I mean, we got Wall Street at some of these all-time highs, even though today a little bit of a correction there, not much. But you were the earliest to call about the real economy disconnect and what the market saw, and this central bank's basically fueling it. I mean, are you feeling vindicated a couple years after putting out that book? And more importantly, what's changed in a couple of years since you put it out?
Yeah, I'm going to do the second part of that question first, because what has changed is, as you said, central banks are buying much more gold than they did 2 years ago. From the standpoint of feeling vindicated about the disconnect or the permanent distortion between the economy and financial assets, or sort of paper assets, that's an unfortunate distortion, because it does mean that people on the ground are feeling more of the pinch every day of the lack of purchasing power, inflation, etc. And so there's good and bad on that. The market, of course, is feeling very good about this, because right now, as you said, and Wall Street's very happy. It's going to all-time highs again.
Yeah.
And that's on the one side. But commodities are actually outperforming some of the big names in the market. Gold is outperforming Nvidia this year, and so we do have that switch that I've been looking at and talking about for some time into hard assets. Yes, led in gold by central banks, but in a lot of these assets now, silver, copper, uranium, rare earths, there's more and more attention from Wall Street and the broader investment community.
It's interesting. We're sitting here in Florida, and I turned on CNBC this morning, Bloomberg, all the rest. And what they're talking about is, basically that the market is being driven by AI earnings and, not distorted at all. Is it just part of the mainstream media keeping the stocks up? Like, where is the distortion here?
The distortion is really from, if we look at the main factors or the numbers that indicate what's going on in the real economy, which is that the consumer is completely stretched. Yes, they're continuing to use credit to buy things, but credit currently is at its historic volume highs. At very high interest rates as well at historic levels. Same thing with household debt. Same thing with U.S. government debt. So we have a very, very increasingly expensive debt-based economy, which is declining. Right, so GDP last quarter was revised to down 0.5%. GDP is not the best indicator of the economy, but it's an indicator that we have historical information for, and it's negative. If you adjust it for inflation, it's down almost like 3%. Meanwhile, the market is hitting new highs on a consistent basis. Yes, with some volatility, pretty much that's direction. That is a problem for the real economy, and that's where growth has to really come in, and that's where hard assets play a pivotal role, not just in the value of themselves, but in the value that they play in all of the power, politics, and games that are going on geopolitically throughout the world.
Yeah, and that capital rotation, I've been speaking to people on the ground, it is taking place. And all this while, central banks, what you've called, it could be the distorters in chief, right? You posted that Powell can't fix tariff-driven inflation with rate hikes because it defies math. What are the dangers of the Fed just staying on autopilot here?
The dangers are the increasing disconnect between even having a Fed, which is fine to not have a Fed, frankly, and what's going on in the real economy. I think what Powell has been doing by dogmatically attaching himself to this idea of we have to have inflation be 2% is unrealistic, given supply chains, given processing chains, giving tariffs. And meanwhile, he's kind of ignoring, and he says he's data-driven, he's ignoring the weaknesses in the economy, the weakness in the jobs market. We've seen the 2-year low print in terms of the job market in the last print, and we see 4.4% unemployment. That's higher than it was going into COVID, when inflation was actually around the same level. So there's a disconnect between what the Fed's looking at and what they're doing with respect to rates. The market almost doesn't care right now.
I know, it's wild to see. I mean, there seems to be some dissent within the Fed for the first time that we're hearing too. I mean, Waller hinted at a July cut. Is the Fed able to adapt to any new process here? Or are they just kind of waiting it out?
They're not. I think there's a big battle of, public battle of wills between President Trump and Jay Powell.
Still going today.
And it's still going. And I think Powell is using that kind of, and he would probably never admit this, but sort of that ego-based lack of approach to basically stay away from doing anything like cutting rates at this point. They had signaled in December they were cut by 50 basis points. The futures market is signaling 75 basis points. I still think we could have 100 basis points in the second half of the year if we continue to get negative GDP prints, right? And higher unemployment prints. This is definitely the things that the Fed is also supposed to be cognizant of. Meanwhile, though, they have walked back on quantitative tightening. 2 Fed meetings ago, they had said they're just going to let roll off $5 to $10 billion of treasuries each month, with on a $6.8 trillion balance sheet is nothing. So they're effectively at neutral right now. They're not doing quantitative tightening because they are afraid of what's happening to the long bond. They are afraid of what's happening to the 10-year. It has not cared about interest rates being cut, and that creates more of a debt burden on the country and on consumers.
It's interesting talking about the Treasury because Secretary Besson, I was just reading on X just before coming to air actually, that the Treasury is boosting the size of the 4 and 8 week bill auctions by $25 billion each. So, I mean, are they just refilling this after the debt ceiling was raised? What are your thoughts?
That's right. And the debt ceiling will probably, if Trump does get his way on that, the debt ceiling will not actually be a thing for quite some time. And even though it's been in process, the debt has continued to increase. So what's happening now is that because rates in the long end have continued to linger at their higher levels, the Fed can control and the market can get into T-bills in the short end of the curve. So the Treasury decided, okay, well, at least we know that the short end of the curve has some value to investors. So we'll just, Fed's made the money a bit cheaper there. We'll issue into that part of the curve. And all that really does is create actually just more of a steepening of the yield curve. It doesn't actually help debt servicing.
So just short-term headline, basically.
That's right.
Well, I mean, it brings us to debt, this quiet signal of de-dollarization that we keep seeing. We saw that big, beautiful bill pass, adding more trillions to the debt. I'm also curious, I mean, you were really loud and early on the call for gold. We talked about it. I mean, last time we were here, you said 2,400. No, we were at 2,400.
We were at 2,400.
You said 3,000.
By the end of the year.
By the end of the year, we hit it. Yep. And then you said 4,000 by the end of this year. We're still on track. I mean, we hit 3,500 on the spot, even though we've taken a little bit, still a foundational 33. What's your thoughts? Yeah,
and I think at 33, gold has found just a little bit of a resting spot before it goes into the next moment. It is still a safe haven. It's still an inflation hedge. It's still all the things that it always used to be. But what's happening more and more is gold is becoming a new monetary anchor for central banks. It's not just a dollar diversifier, that is one thing, but it's actually becoming part of a new monetary anchor system, I think. And because of that, it means that central banks are going to continue to stockpile gold. 95% of them said in the last survey by the World Gold Council that they're going to continue to increase. Nobody's selling their gold.
And they don't care about the price.
They don't care about the price. Some they get off market, some they get in the public market. We don't know. We don't know where China's actually getting its gold all the time. But what we do know is it's increasing its percentage, not just of the central bank. And this is what's key, and I think people who are invested in gold, who want to get invested in gold, have to understand about why there's so much more upside.
Right.
China, for example, is telling its state banks to buy gold too. The state banks are telling individuals to buy gold too. So you have a very large country with very deep pockets telling it was very controlling of their sort of systems and people to buy gold. And then that message is going across other central banks with which they have strategic trade partnerships. In a world in which there's uncertainty about tariffs, you put that all together, and the only thing that has power certainty in the monetary system actually is gold. Right. And that's not going to stop.
No. And I mean, you're seeing it from BRICS. Of course, they were meeting recently in Rio de Janeiro. And I don't think President Xi was there, nor was Putin at this meeting. But Trump called them out and said, you're destabilizing our dollar by creating BRICS. That's the goal. So I'll put a 10% tariff. I mean, should we take a little bit of a hint that the fact that those two leaders weren't there, or is this just more smoke than fire?
I don't think it really matters. First of all, I don't think a 10% tariff to anyone who is trading less in dollars than they were yesterday is really going to make a big dent in their own economic systems. They'll just trade with each other. They'll figure it out. It's really, I think that particular tariff threat is really just that. It's kind of smoke and mirrors because it doesn't really actually matter. But what is happening is these countries, regardless of whether they are shunning the dollar or simply reconstituting relationships with each other and strengthening their own ties, which is actually what's happening. It's the byproduct. Yeah. That's going to continue as well. So when the BRICS it was actually interesting. I was in Rio at the G20 last year. Mm-hmm. And what was really interesting is what wasn't told on the headline news, what wasn't actually covered. And that was that these leaders were getting together not to talk about a dollar currency alternative, but to talk about payment systems that they could use that would almost act as instant translators to currency. So China could trade with Russia over the new payment system. It could be SIPs, which China's developing, or whatever it looks like. And it's instant. It's like an instant translator of currency. So that bypasses an alternative currency to the dollar by having a bigger alternative platform to the dollar-based platform of SWIFT. That's a huge movement. Yeah. That's continuing.
Makes sense. I mean, they came in and kind of weaponized SWIFT, brought a lot of countries out, and this is them saying, well, here's what we're going to do.
That's right. And it's really interesting because 20 years ago or so, that the idea of the fear of, we're going to have this new currency 10 years ago, 5 years ago even, has been basically supplanted by this idea that, it's not that necessary. It's not even, we have the technology to not bother about creating a new currency. We just have to make our payment systems faster and take each other's. And we do our deals, we ink trade agreements that are connected to this payment system. Way easier. We have the technology. The data is there to have that.
Do you think they're full steam ahead, or with Trump's little, trying to discourage them from going forward, are they slowing down the process?
They're not, and the reason they won't is because we're almost at midterms. Yeah. Oddly enough, we're almost at midterm elections, and then you have 2 years. Who knows what's going to happen? They're in this for the long haul. They put a lot of money and thought and strategic energy into developing alternative payment systems for their own digital currencies as well as to communicate with each other's. They're not going to stop because tariffs went up by 10%.
Just too far. Speaking of those tariffs, it's said that Trump just imposed that 50% copper tariff, as we talked about. Now, you warned for months about the collision between, tariff shocks and energy disruption. What are the markets mispricing right now?
What they are mispricing is the need for both energy processes, infrastructure, development, wiring to continue no matter what and however the economy is doing. Because things need to be electrified. There need to be copper wiring, not just in the United States where we have an abysmal system of the grid right now. Everything needs to be restructured, but also China and India and so forth. And what China did a couple months ago, and it was one of the main countries that did this in copper, was when the administration came out with something called a Section 232, which is basically to investigate certain minerals to determine whether they're critically important to national defense. For the first time since that act came out that had 232 in it, which was in 1962, they labeled copper as something to look at. The results for that investigation are supposed to be out in September. Meanwhile, there was a 60% depletion of the copper that backs futures contracts on the London Mercantile Exchange, which has helped to bump the price of copper up. You add to that the potential tariff of 50% on copper, and you see why stockpiling of copper was going on and why that price has been pushed up. Add that September is when these results come out, we could see significant upside in copper.
Yeah, absolutely. I mean, even with, you put a tariff, it's not like you can move a copper mine.
And you can't just start a new one. Yeah. So you have to be in jurisdictions that are already permitted and mines that are operating. Some of the big mining companies have that, and some of the junior mining companies have that as well. But ones that are just in the process, it's going to take a minute.
Yeah. You've always been talking more about the commodity side as opposed to just gold and silver specifically. So what is Wall Street going towards right now? Are they looking at this opportunity? I mean, people are talking about copper. They're talking about strategic minerals. They're talking about uranium.
They are, and Goldman Sachs actually just put out a recent report about why uranium mining stocks are a good place to invest right now, and that's a very new thing because Goldman was historically, when I started Goldman back in 2000, their commodity, the only commodity they cared about was oil. Like literally that's all they cared about. Gold wasn't even a thing. We never did anything in gold. It was basically maybe a bond hedge. No one cared. We have seen a $330 billion outflow in investment in bonds and a $230 billion inflow in commodities in the investor community. There has been a significant rotation into hard assets. Yes, a lot of that's gold, silver, it's copper, it's uranium, it's a little bit of rare earths. I think that is the place to be in right now if you are a long-term investor who's interested in making real money. It's going to take a minute as well. But these are areas where there are need values attached to these assets. Gold, monetary anchor, silver, industrial use, copper, wiring the world, uranium, powering the world, rare earths. We can't communicate without rare earths. Every single person with a cell phone has a portfolio of rare earths that are processed in China in their pocket. These things have to evolve.
Just keep talking about where the money is going, because last time we had you on the show, you flagged LNG, you flagged uranium and copper months ago. And, here we are talking about all those assets today, up quite substantially. Why are the sectors kind of outperforming right now in terms of that? We know commodities are cyclical, but they're doing quite well.
They are, because policy, from the standpoint of power policy, whether that's energy, which is necessary for defense, or defense, which is necessary for defense of all the countries in the world, but sort of led by the US and China and their allies and however they trade with each other, are realizing that they need to be more involved in the policy around assets. China knows this. That's why it has basically stockpiled a whole bunch of copper just down here. But the U.S. is also doing this. And I think what's also happened since we've been chatting is there's a lot of stuff this administration does that doesn't have anything to do with hard assets. But the things that they're doing with respect to talking about critical minerals reserves, talking about deregulating some of the Nuclear Regulatory Commission onerous permits for building processing capabilities for uranium. These are all things that are coming into play because nations are recognizing that if they don't have power and they don't have the means to transport power and they don't have the ability to control their own defense products, they're a weaker nation. And all of that is happening around the world. I think the tariffs have kind of instigated the next level of that. It was happening anyway. But that's where we're at now. So anyone who wasn't in hard assets until now,
start to go.
Significant opportunities.
Yeah, it feels like policy around the world is shifting a little bit more positive on the mining side. At least they understand it shouldn't take 18 years to get something going. So that brings me, if investors are looking for upside here, do you go after the big names, Cameco, Fremont's? Are you Freeport, or you kind of more small cap? You've been talking to quite a few companies over here.
Yeah, and I think you have to have a solid mix of both. We've certainly, we've got portfolios of Prinsights which look at the big names, the fully up and running mining companies that have good relationships and permits and are in good jurisdictions around the world, like the Comicos and so forth. Mm-hmm. But then you also have UECs and other companies like that, which are just sort of in that junior spectrum, but are producing, have again good relationships that are in the trend of policy that you have to look at. So I think you have to be in both. I think it's very important to be in both in all of these assets, the bigger players and also the junior miners, not randomly, but the ones that are in jurisdictions with as neutral as possible and as supportive as possible a set of government policy behind them.
Yeah, and management execution. You look at UEC, and through the cyclical, when all the billions were going to wind and solar, they stuck it through. And you got to give them that. And here we are in this market, but we're still almost in a supply crunch with uranium. They know that there's more. So do you think that that's a bigger opportunity now than copper?
I think they have different reasons for both of them being an opportunity. I would say that uranium has a bigger opportunity, but over a longer time period. Our portfolios are more weighted in uranium than copper, but we also have positions in copper. And specifically what we're talking about with the 232s makes us think that that's a really good place to be. Uranium is very much a part of the geopolitical power game, and it's going to continue. I don't think we're going to turn the switch off on using nuclear energy. What's really interesting about uranium now, and why I've been bullish about uranium for many years, but now in sort of re-entering positions or finding new names, is that there's a lot of attention on bringing the power to the place. Mm-hmm. And what that means is there's more attention on small modular reactors, micro modular reactors, and the companies that are aligned, that have the capacity to enrich uranium or access enriched uranium that doesn't come from Russia and doesn't come from Kazakhstan, those are the companies that are at the forefront of the sort of next wave of power, just period, of nuclear power, of getting power to the end run. And basically powering anything from AI to defense.
Yeah, which we obviously need more of. And they can put it back in the grid, too, from there, right?
That's right.
Yeah.
That's right.
It's fascinating because when we talk about retail strategy, and I mean, we're talking to the investors here in Prinsights Global, which if you're not a subscriber to, you should be. You said investors should follow the money trail before it becomes narrative. So specifically, everything we've kind of talked about, I mean, what are those specific market signals that you're looking to cut through this noise? Every day, my tweets, everything, we got to still produce a show. What are the market signals? What are the sectors? Yeah. And, where are you going to find that upside? Any companies you can give us?
Well, again, we've talked about some, and we have others in our portfolio. But, I think rare earths is definitely a sector that people should be involved in if they're not. Mm-hmm. Companies that have the ability to be a part of like the geopolitical movement. I mean, I look at, one of the reasons I'm on the board of Meteoric Resources, which is an Australian-based company, mm-hmm. but with an asset one of the largest actually, in fact, rare earths asset in Brazil, in the world right now that's close to the surface, is because I believe that's a very important part of where politics, defense, energy, permanent magnets, et cetera, is going to go. So I think it's important that people who invest, especially in hard assets, because they're so geopolitically connected, understand where they're investing. Where is the asset? Not just what is the asset, but where is the asset and how stable is the infrastructure, the government, the situation around that asset. So that's what I look at. I'll look at geopolitics before I'll look at the company. With respect to an asset every day, because it's very important to know what's happening around it before I look at their balance sheet. They could have an amazing balance sheet, but if their country is going to take over their assets or close it, it doesn't matter.
We just heard about this with Barrick and Mali, obviously, right now with the reserves. I mean, how important is that jurisdictional risk? Is it priced in for those in safer jurisdictions, maybe?
To an extent, but in some of these junior mining companies, for example, companies in Morocco or companies in Argentina, where it might seem like there's less awareness of what the jurisdiction is. If it's positive to those miners and those companies, then it's going to be bullish over the long term if the management's good, if all the financials work out. So I think, and I talked about this actually here at Rule today. It's the first time I really talked a lot about jurisdiction over price. Mm-hmm. Because I think in the future, especially what's going on geopolitically from a power perspective, everything we're talking about until gold anchoring, sort of not reset, but evolvingly reset monetary system, it matters where things are sourced, it matters quality, and it matters that the pathway is going to stay open. Yeah. You can't have a crystal ball. There could be, a meteor could fall in the middle of Kansas or whatever, or things can happen.
But it's important, in the due diligence.
But you need to know. Yeah. You need to know. Jurisdiction is super important. Custody chain is super important. How that material gets from the ground to processing to it's all incredibly important as much as the asset itself.
What does the end game look like? You and I have talked about this before. If this distortion is kind of permanent, do we see stagflation or do we see a slower crash? Is it happening now? How do we quietly realign into something positive here?
Well, we are seeing stagflation, right? Just by negative GDP, and again, not best measure, and even a little bit of inflation, you're effectively at stagflation. Right. But that's why, from an investor standpoint, you have to be in hard assets. Yes, you can chase NVIDIA, that's fine, or the next NVIDIA, that's fine. We don't tend to do that. Gold has outperformed NVIDIA this year, so is silver, so is copper. But what you have to understand is that the only way for an investor to really combat that distortion and that stagflation is to be in hard assets.
Amen. I feel like the audiences are starting to understand. Even a year ago, I was talking at $2,400 gold. It's a lot different here today. Do you feel like they're opening up? People are starting to get, I've been talking to some of the majors who are taking a lot more meetings this year.
Everyone's taking more meetings this year. I know the conference has expanded in terms of attendees, in terms of the CEOs that are representing companies here coming instead of sending their number two person. There's a lot of sort of evolution in who's even physically here. And I think that's because there is more attention on hard assets. And it's because, and I titled my talk Hard Asset, Real Asset Uprising, because it's not just about the price, it's about the movement, it's about the control, it's about the jurisdiction. I think what's happening right now, why there is so much buzz, is because if you realize that's all happening around these assets, then you have to be excited about the price of the assets. Because the need is there. The demand is going to pull the supply faster and upward for the right companies.
Okay, well, I hope we're talking at $4,000 gold. We are talking. Okay, I appreciate you. And I know that talk is available here at the conference. And Rick is going to show it after. I think he's got some pre-recorded or some post-recorded. So if you want to find out more back home. And also talk a little bit about Prinsights. I want to, just so the audience understands, because the insights and the nuggets that you give, not only that, but you also have like a little portfolio, some suggestions there.
Yeah, we have two different tiers as well as free material at Prinsights Global on our Substack, prinsights.substack.com. And one is kind of the bigger mid-sized companies that are in the commodity, natural resource, and supplier, logistics, electricity. So the entire infrastructure around hard assets is pretty much our focus on a mid-cap and a large-cap basis. And then we have a small-cap one that we just launched, which is basically those junior miners that really hit for us all of those boxes, but also they have good strategic management teams that I know. I've been to visit their mines, or the team has, and that we have a real solid feeling for their long-term.
And executive teams, I mean, they're watching M&A close right now. They're looking at every company, it feels like.
There's a lot of M&A to come in this space. There is a lot of M&A because people, especially in gold, there's a lot of money that was made at the bigger gold companies, and there's junior miners that have produced or are producing viable gold supply, and that's a perfect recipe for a merger.
Keep printing cash. I hope they continue at 4,000. All right, Dr. Nomi Prins joining us now. Thank you for your time, as always. I appreciate it.
Thank you so much.
I'm Jeremy Szafron. For all of us here at Kitco News, we'll be at the conference all week long, so don't forget to hit the subscribe button. We'll see you next time.
Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.